latest meeting of the US Federal Reserve has come and gone, and once again, markets were left waiting for the first interest rate hike in America in over 9 years. Despite robust economic activity and solid jobs growth, the Fed outlined lingering concerns on inflation expectations and market volatility as the key factors holding it back. While the no change outcome was not overly surprising, the announcement was accompanied with a somewhat negative view. This in turn has pushed rate hike expectations further into the future. But doing nothing is doing something, and with equity markets entrenched in correction territory, messaging clearly matters. Markets haven't exactly responded well to Janet Yellen's views on growth in China and other emerging economies, market volatility, and the overall tightening of financial market conditions. This leaves the outlook for financial markets open for debate. On the one hand, the decision can be taken at face value where the Fed has exercised caution. With an improving labour market and sound domestic economic growth, the decision has simply been delayed until December or early 2016, and the market response has thus been overdone. On the other hand, the uncertain outlook abroad, as noted, has a more sinister element, and the tightening of financial conditions and turmoil caused by the Chinese currency devaluation could yet derail the US economy. The Fed's lack of certainty and ability to deal with any looming problems could see markets quickly lose confidence. While emerging market stability is again in the spotlight, we think the threat of a spillover into the US and the growing levels of pessimism in general is probably overstated, but does warrant caution. Either way, the lack of clarity will keep markets jittery for the foreseeable future. We are now closing in on 7.5 years of ultra-low interest rates in the US, and interest rates in Australia also remain at record lows. Undoubtedly, there have been distortions fueled by the low cost of money. The impact has also been acutely felt by retirees who would otherwise rely on the interest income generated on their savings. To compensate, many have moved out of their risk comfort zones in the hunt for yield. This can work in periods of low volatility, but the landscape seems to be undergoing a dramatic shift on policy change and market uncertainty. Reconciling the forces of longevity risk and sequencing risk with assets that can generate income and protect against inflation therefore remains a distinct challenge for many. Equities can be part of the solution to a well-diversified portfolio, but now may be a good time to review any inadvertent skews to the likes of expensive defensives and highly geared balance sheets. For investors, it remains sensible to keep risk management front of mind, as trying to time the market on this type of short-term noise is next to impossible. A well-diversified portfolio remains a good starting point to mitigate risk, but for those who remain cautious on equity markets, investing in low volatility equity funds is another way of gaining exposure to shares without riding the highs and lows of market sentiment. A share portfolio that is able to utilise exchange-traded options can be managed to generate attractive levels of income at lower levels of volatility than the overall market. We invite you to follow our new Pioneering Insights blog to keep up to date on Zurich's views on global markets and the opportunities they bring for investors at pioneeringinsights.com.au.